Hello and welcome back to The Note. We are still only 4 days on from Britain's historic vote to leave the European Union, and if anything, things are growing ever less clear by the minute. What on earth is an investor to do about these levels of uncertainty? With me now to discuss this is the Chief Investment Officer of UBS Wealth Management, Mark Haefele. Mark, thanks for joining me once more.
Thank you.
How does this vote, how does this result change your forecasts, your economic forecasts for the year compared to where they were before the referendum was called?
So we've lowered the UK to probably flat economic growth for the next year, 18 months. We've taken our forecast for European growth down about 1/4 percentage point. But for the US, we're still, we think that's still on track.
So bad but not disastrous.
Mm-hmm.
What further shoes might need to drop for you to get more negative about that?
Well, we're watching spreads within Europe, both on the sovereign side and on the credit side. If money becomes more expensive, if it becomes more difficult to borrow, then I think we're going to grow more concerned.
Okay, and so far we do not appear to have seen that, but plainly it remains a risk to be concerned about. If we look at asset allocation, how do you go about allocating towards Europe? It was obviously a popular call earlier this year. It looks relatively cheap compared to the rest of the world. How do you go about allocating to Europe?
Well, I think the most important thing that this event shows, it reconfirms the need for global diversification across political, economic regimes. And I think for us at this point, to the extent we're allocating to Europe, what we like is European high yield, where we think that the European Central Bank is in there working on credit spreads by buying corporate assets, and that should also benefit the high yield market.
Okay, so there is an opportunity there. When we look at quality government bonds in Europe, gilts are now at their lowest yield ever. Bunds stunningly have a significantly negative yield. Is it possible to shelter in European quality bonds to any extent at all?
Well, we don't have an overweight there. We're underweight given the historic expense. We'd rather see clients take some of their bond allocation and perhaps switch it to alternative assets like hedge funds, which can add a better risk reward for a diversifier in their portfolio.
So again, to be clear, you're not necessarily saying they're going to perform brilliantly, you're just saying that they are a better diversifier at this point for a portfolio than an overexpensive bond.
Exactly.
Okay, now if we take a look at currencies, obviously by far the most dramatic moves we've seen so far, how do you go about hedging currency risk, particularly I suppose given that there is now some uncertainty about whether the British go through with this? Where do you have clients moving their money when it comes to making those currency calls?
Well, on the currency side, as you've said, we've seen that really bear the brunt of this. And so for us, we think a lot of the currency moves have happened. One of the places I think we see something of a hedge for the portfolio on the currency side is to be underweight the Australian dollar versus the US dollar, because things like slower growth in Asia have been off the table, but should they come back on, this important trading partner of the UK may face an additional headwind.
Okay, so very counterintuitive, but there are still some ways to find a hedge. Finally, in the heartland of equities, we've seen a very sharp continued improvement in the performance of high-yielding stocks, which I guess you can explain given what's happened to bonds. Is that an overdone play at this point? Where does one shelter in stocks for the next few months?
Well, we still like the U.S. equities because the U.S. market is relatively insulated from both direct exposure to the U.K. and to some extent Europe. And so because rates are likely to be lower for longer, we think that there's still some room in the dividend stocks and in the stocks with high free cash flow. So we would look at that across that group of stocks across regions.
And I guess I just said the last question was the final question. it seems to be fairly clear you're not suggesting doing anything too drastic while the uncertainty remains high. Is that fair?
I think that's very fair.
Okay, Mark, thank you very much indeed. Basically, until any of us really know what's happening in the British, it's unwise to do anything too extreme. There are, I hope, some useful ideas there for things that you can do that are at least somewhat constructive.